Welcome to The Explainer. Today, we're going to look past just the stock price and dig into two critical metrics that show you what's really happening in the market. Let's dive right in. You know, when you first look at the stock market, it can feel like total chaos, right? Just a dizzying blur of flashing numbers and jagged charts going up and down. It's so easy to think that the only thing that really matters is the price. But what if I told you that there are two other vital signs that tell the real story behind all those price movements? To see that hidden story, you need the right tools. So let's think of this as building your personal investor's toolkit. And the very first tool we're going to put in our belt is trading volume. This is how we get a read on the crowd's interest in any given stock. So what is it exactly? Well, to put it simply, trading volume is just the total number of shares that change hands over a certain amount of time, usually a single day. Think of it as a direct measure of how much activity or buzz a stock is creating. Here's a simple way to think about it. A high-volume stock is like a really popular, busy restaurant. It's buzzing, and it's easy to get a table, or in this case, to buy or sell your shares. A low-volume stock? That's more like an empty restaurant. You might have to wait a whole lot longer to get served, because it's just plain harder to find a buyer or seller. So why does this all matter? Well, volume gives you some critical clues. It signals how strong investor interest is. It tells you how easily you can get in or out of a stock. That's what we call liquidity. And if you see a sudden, massive spike in volume, you can bet some big news just dropped. On the flip side, low volume can actually make trading more expensive. Okay, let's grab the second tool for our kit. If volume tells us about the crowd's interest, then volatility tells us about the stock's personality. It gives us a sense of its typical behavior. Is it calm and predictable, or is it prone to some pretty dramatic mood swings? In simple terms, volatility is just a measure of how much a stock's price swings up and down. It's all about the size and the speed of its price changes. So a high volatility stock is kind of like a roller coaster. You get these thrilling highs and some pretty terrifying drops. The potential for a big return is higher, for sure, but so is the risk of a big loss. A low volatility stock is more like a commuter train. The ride is a lot smoother, more predictable, but your potential returns are usually going to be lower. And this right here gets us to a really fundamental trade-off in all of investing. Are you looking for that greater profit potential that comes with the big swings of high volatility stocks? Or do you prefer the stability and lower risk that comes with the low volatility ones? You know, there's no right answer here, but it's a question every single investor has to ask themselves. Okay, so we've got our two tools, volume and volatility. But here's the thing. The real magic, the deep insight, happens when you stop looking at them separately. It's time to use them together to get a much, much clearer picture of a stock's risk. And this is where it all comes together. The investor risk matrix. Let's break it down. Top left, you've got high volume and low volatility. This is generally lower risk. The stock is stable and it's easy to trade. Now, top right, high volume but high volatility. It's still easy to trade, but the price is unpredictable. That's a higher risk. Bottom left, low volume and low volatility. The price is stable, which is good, but it's hard to trade, which creates a moderate risk. And finally, the bottom right, low volume and high volatility. This is usually the riskiest spot to be, an unpredictable stock that's also really difficult to buy or sell. So, we've gone through the theory. Now let's talk about the important part, how you can actually use this new knowledge, this new investor lens in the real world. It really boils down to three pretty simple steps. First, you've got to know yourself. What's your personal risk tolerance? Are you a roller coaster person or a commuter train person? Second, from now on, whenever you look at a stock, look beyond just the price. Make it a habit to check its volume and volatility. And third, use this knowledge to diversify your investments. Mixing stocks from different parts of our risk matrix can really help you manage your portfolio's overall risk. Ultimately, this is what it's all about. These aren't just some obscure numbers for Wall Street analysts. Understanding how the crowd's interest, that's volume, and the stock's personality, that's volatility, work together is an absolutely crucial piece of building a smart investment strategy for yourself. So then next time you pull up a stock chart, don't just stare at the price line. Look a little deeper. Check the volume. Check the volatility. Because now you have the tools to decode the hidden story. So, what are the stocks you're watching really telling you?